Here's what's interesting. I think the Fed is in a very, very difficult position right now because I think that the Fed moved from a very accommodative position on rates to a very hawkish position very quickly. And that's never really happened before. And I think that's probably because a lot of political influence, the Biden administration is getting a lot of heat for their mishandling of inflation. The problem with this is it's on a very teetering slope where if they go too aggressive and they push too many hikes or hikes that are too aggressive, it could very rapidly put us right back into a recession type of environment.
Welcome, everyone, to the Investment Agents Podcast. I'm here with two absolute rock stars with Blue Oak Capital, a Houston-based private equity firm focused on the acquisition of multifamily real estate all across the U.S. We have Cody Laughlin. He's the head of acquisitions, and Brian Alfaro, the head of investor relations. How y'all doing?
Doing great, Chris, man. Appreciate the opportunity to be here.
Really, it's my pleasure. I love talking with folks that are in the churches doing big things, and it definitely describes y'all. Y'all are the first guest we've ever had on that. It's like a dual podcast guest, interview. So, congrats.
Thanks. We tend to get that a lot here lately, Brian.
Yeah, we do.
That's cool. So, I want to start off because I think this is pretty important. A lot of folks that are like. Real estate is a team sport, whether you're a realtor, whether you're a single family investor or especially commercial and multifamily. Like you can get away as a realtor kind of doing it one off. There's always other aspects and other people you're going to rely on, but you can do a lot of stuff yourself. But multifamily, there's so many people that are required for just taking down a single transaction and then managing them. So there's two of you, and y'all have known each other at least for a little while, and you're working together with, just blowing the lid off Blue Oak Capital. How did y'all meet?
Love this story. So there's actually three of us here at Blue Oak Capital. Our third partner, John, obviously is not here, but it's the trio. And, our story and our journey really started back in 2019. I had met John through a mutual connection when working on another investment opportunity. And at the time, I was kind of flying solo, trying to put together an infrastructure of some business. Along came John, and we started discussing synergies, started kind of going through the process of different exercises, underwriting analysis, deal tour, property tours and such. And really just kind of cemented that alignment of interest. And once we really established that, we decided to, hey, let's make this a formal partnership. And we did. We launched Blue Oak Capital early 2020. And, as you mentioned, man, there's just so many responsibilities, so many different tasks to do. And even just two people, it was clearly not even close to being enough help. And so, we were gaining a lot of momentum in some areas of our business and lagging in some others. And so, John met Brian through a Neil Bawa boot camp virtually, and they connected offline and started having some discussions. And I think coincidentally, we're all here in Houston. John and I had joined a mentorship program that Brian was interested in joining at the time that they connected. And, then we all got together and, continued the conversation, and kind of we opened up our framework to our business and said, look, here's what we're doing. Here's what we think is working well. Here's where we need the most help at. And, gave Brian his time to shine and see if that was a fit for him. And it was a perfect alignment, I would say. And, and it was just a great fit. So rare opportunity, I would say. It's rare that you ever meet somebody the first time and it ends up being a long-term relationship or partnership, but we were fortunate to have that. And here we are now, almost 2 years later, making some big things happen. So,
love it. Was John? Was he the other gentleman that I met in Orlando?
He was. Yeah.
Awesome. So, John, sorry that I left you out there. But Brian, do you have anything to add to that on how that unfolded?
Yeah, I mean, very similar to Cody. I mean, Chris, you and I have actually known each other longer than Cody and I have known. I used to go to your meetup, right? So I was in the single family side, and I was kind of doing that. I was, wholesaled a few deals, helped flip a few deals, had a couple of rentals, and just really quickly realized that I wasn't getting the ROE that I was looking for, the return on effort. Properties were still cash flowing, equity was still building, but I wanted to build a scalable business. And what really aligned with my personal investing philosophy and my business acumen and my background was just building something that I could scale, right? So I decided to pursue multifamily because it aligned with that investing thesis that I had. As he mentioned, I met John. I ended up joining the same mentorship group that Cody and John had just joined as well, and there was really a big alignment of interest in not only the X's and O's, like what type of properties do we want to buy, where do we see this business going, but there was a huge personality fit as well, which is really important. Forget the dollars and the cents and the buildings and the bricks and all that. You got to like who you're working with at the other end of the
100%.
table, because things aren't always great, and we've had a lot of tough times, a lot of no's before we hear some yeses, right? So you got to have people you want to wake up every day and sort of go to bat with, hit the field with. And Cody and John were great people, and I knew that from the beginning. So we kept the conversation open, and I felt like I had a skill set based on my background that I could add to them, and really just put a little bit of fuel on the fire they already had lit. And we started working together and realized very quickly that it was a good fit. And like Cody says, that is a little bit rare, but at the same time, it happens if you find people with high integrity, good morals, and that, you ask the right questions and make sure that everything's aligned and you communicate. I think that's one of our biggest strengths is we communicate really well together. If I drop the ball on something, Cody tells me. If he drops the ball on something, I tell him, and there's no emotions involved. Nobody's getting mad at each other. We just want to do what's best for our investors, do what's best for our assets, and do what's best for the business long term so we can all grow wealth together.
I want to stay on this topic a little bit longer because it's rare. Well, so you've got a great partnership. It didn't start out where instantly you're like, hey, let's all get together. There was a process involved of building a natural relationship, getting to know someone, seeing if there's a personality fit, an ethics fit, a work ethic fit. And that happened, amongst the three of you. So now you're working together, and there's talking about delegation of tasks, and also micromanaging, keeping that in. So how do you delegate responsibilities, and how have y'all delegated responsibilities, and also holding each other accountable to those without stepping into the boundaries of micromanaging? Because that can be challenging.
Yeah, no, it absolutely can. And to answer the first part of your question, so when at the time that we met Brian, we had already had a foundation, right? We had already had a database that was growing. We had broker relations, vendor relations, in that database that was also growing. But it was just so hard to navigate both at the same time, plus push the marketing and the branding and awareness out. And so, when meeting Brian and really kind of discovering what his value proposition was, what his skill set was, coming from an operational background in his retail coffee shops, he had that marketing background, he had that operational background, he had that just knack for just marketing and branding and what we call the brand ambassador, so to speak. And so, when we sat down and kind of talk through, hey, what are those skill sets? How do they match with what we're doing already? Then it was kind of that immediate division of labor. Okay, well, Brian, here's where you can help us out tremendously, or if you're interested, vice versa. And then, I can continue building out the broker relations, the vendor relations, the deal acquisition pipeline while Brian takes over this and that. And then we have our third partner, John, who's kind of more in the background. He's kind of like, we like to joke, he's kind of like our COO, our operating officer, handling some the behind the scenes tasks. But I think that was kind of the initial division of labor, and it just kind of fit each of our skill sets very well. And we felt comfortable in each of those lanes. And that's really the path we've taken. Brian, I don't think I missed anything there. Would you agree?
Oh no, I mean, for me personally, it's all about the team success, and I am of the mindset that I'll do whatever you need me to do in order to whatever's going to move the needle, right? So at the time, what was going to move the needle was they needed help with investor relations, and they needed help with marketing and building relationships with people via the brand, which is something I was very familiar with. So it was a natural fit for me. But if Cody had came to me and said, hey, we really need help with acquisitions, and I already had a little bit of experience on the acquisition side, on the single family side, then I would have picked up that toolbox, that tool, and put that in my tool belt as well. So I think when you're getting started in commercial real estate in particular, because it is a team sport, we like to tell people, figure out what your superpower is, figure out which hat you want to wear. Because if you're going to buy these big buildings, we're buying 10, 20, $30 million buildings, right? These are not little 150, $200,000 houses. Not that there's anything wrong with that, but it requires a team effort. And you really gotta be good at something and sort of specialize in something. Not that you can't, understand different parts of the business, or at least be, competent at it, but you do have to have a superpower. You either have to be really good at going to find deals and understanding that those relationships are really important in order to get those deals, and underwriting and all the vendors and the capital market side, or you have to be really good at raising money. I mean, that's it's as simple as you can dumb down real estate. Is you either have deals or you have dollars.
Yep.
Of course, there's operations and there's asset management, because after you close, that's really where the work begins. But to kind of simplify it, you have to be good at one or the two, one or the other. So I think for me, it was understanding that Cody was really good and had a natural knack and was really building momentum on the acquisition side. And then John was a little bit more time constrained. So even though he was good at relationships and stuff, they needed help with that brand building, that investor relations side of things. And that's where it just kind of came to be a more natural fit.
I love
Yeah.
it. Yeah, I just wanted to stay on that because most people don't realize that business partnerships, it's a marriage. It's a contractual business financial marriage that, when done well, thrives. But there's always hiccups that come in, and you alluded to team first, being there for the team, being there for the mission of the company. That's actually one of our core values: team first. And then another aspect of just valuing the relationship and respecting to each other in their roles. So I love it. All right. Oh, yeah, you get another thought there?
Well, that was going to be a great segue into the second part of your question. You asked about how do you manage those boundaries of not, like, putting the trust in your partner, but not micromanaging. And
Mhm.
I just wanted to highlight, like, this is where the vetting process becomes so critical when you're first dating, quote unquote, right? Is taking the time to really vet your partners and the people you're working with, and going through those exercises, and assigning tasks and saying, hey, take this responsibility, go do it, and then let's see if you can perform. And then, can we communicate in a way that's effective for all parties? And that's huge. I mean, everything, just relationships in general, it all comes down to communication, right? Take your time and go through that. And I think that's what's really helped for us. And Brian, I think you mentioned this earlier, right? Where we just had a really great communication style that was a fit for all of us. It was very cohesive, very transparent, authentic. And so, we were able to establish that trust very early on in our relationship, to where if Brian was working on a task, he took the bulls by the horns. He went and gave it 102%. He knocked it out, came back and kept us in the loop. And then, he performed the task above and beyond what needed to. And hopefully, the same was reciprocated on our end, myself and John. And so after you've experienced that enough times, then there becomes just a genuine trust, where I know if Brian's working on something, I don't worry if he's going to be able to get it done or not. I know he's going to take care of it. And if he needs help, we're here to back him up, and vice versa. And, but it all comes down to that initial, dating phase where,
Mhm.
you can't just jump head in first and wish for the best. You really need to take your time and make sure that cohesion is there from the beginning, or else, things can crumble really quick. So.
Love it. Love it. All right. First deal. So Cody, did you come from single family? Did you do single family first?
I
Okay.
did. Yeah. I
Right.
spent about 8 years in single family, had some buy and holds, did a little bit of wholesaling for like half a minute, and then some single family flips. And I tell people, single family, the flips is what really pushed me over the edge. That's where I was just like, you know what? Like, I'm tired of working myself into a second job. Like, I'm tired of just like Brian always says, like, that's so little return on time and effort.
Yeah.
And I was like, I needed to do something that had more efficiency, more scalability, and something that I can enjoy partnering with others with. And so that was kind of my transition into multifamily. So
It's a job, right? It's just like going to work and making money. I
It's
mean, I'm not saying it's not fantastic. It can be, have a lot of upside, right? You can make 6-figure checks on a flip, but it's taxed like ordinary income. It's a job. It doesn't help necessarily with your wealth building over time with equity, the way buying rentals or multifamily commercial assets can.
yeah, and the extra point, once you stop doing the activity like a job, the income stops too. So
Yep.
6-figure check can happen, probably not incredibly common for if you average it out. But whatever that check is, yeah, it's a job. You stop doing the activity. So that's where holding, the only way you build wealth is you have to hold assets, and real estate just happens to be an asset that pays you money. So how did you make that transition to your first multifamily deal? And I don't know if maybe that's the first, if y'all have the same first deal or what, but ultimately making that step, closing on your first deal, what did that look like? How'd that happen?
He's got a great story on his almost first deal.
All right, almost first deal. Let's do it.
Thanks, Brian. Yeah, no, I made the transition to multifamily in 2019. And for anybody that's familiar with multifamily, you have to have three things: experience, net worth, and liquidity. Well, I had none, right? I had nothing substantial of either of that to build a multifamily business on. So I started from nothing. And just like everybody else, I started, immersing myself in education, podcasts, books, and going to different local meetups and just trying to figure out a path, a direction. And I started discovering who the industry influences were and following the framework about, how to build out your network, how to build out your database, building relationships, and then what are the other key components in your business that you need to be successful multifamily. And through that, I actually joined a much smaller mentorship program, kind of early 2019. And I met a connection there, a friend who I'm still friends with today, but a connection there, a guy based out of Dallas, and go getter, just had this fiery spirit like I did, was very motivated, and we started building a relationship. And through just continued conversation, it was discovered that he actually was working on a deal. They were under LOI, and he reached out to me and said, "Hey, I know you're looking to get started. Do you want to come in and help raise some equity for this deal? And we can all benefit together." And I was gung ho. I was like, "Yes, absolutely, sign me up." And it was a small commit, like $300,000 is what they needed me to bring, right? And so
Which
I
is probably
started.
laughable now, in the deals you are doing.
It is, and what's even more laughable now is, to make that long story very short, is I ended up converting $0 out of my commit on that raise, and it was the most devastating moment for me. I was like, "Oh my God, like I can't do this business. I'm never going to be successful. Like nobody's going to want to work with me if I share this story." And it was just really one of those low points very early on in the business. But once I got past that and reflected on what had went wrong or what did I miss, it was very evident to me that I still had so much more growth to go, so much more learning to do. And it was in hindsight, it was one of the best experiences I ever could experience, because, from there, it really got me disciplined and honed in on just the exact things that we needed to put in place to really make this a scalable business. And then a coincidental timing, again, met John, Brian, and Brian coming into, we were all following that same framework, that same vision, that same step. And so it was really just a plug and play. We were all following the same influencers. And now you fast forward, we spent about, Brian, I don't know, I'd say almost 18 months, 14, 18 months in total before getting into that first opportunity where we co-sponsored with another experienced operator, and we raised equity for that. And we brought $1.3 million to that deal on our first raise. And it was a 506C raise, but it was all of that work in between that first opportunity in 2019 to that deal, and putting in this infrastructure in place that really allowed us to maximize that opportunity on that first one. So
yeah, people usually, I mean, they see the end result. They don't see the foundation laid prior to that. On the 300,000, reflecting back on that, knowing what you know now, what do you think went wrong and not able to convert? I mean, there's always folks that say, "Hey, I'm good," and then circumstances, or they just change their mind. But what do you think really went wrong on why you weren't able to convert the 300,000?
Yeah. How long is the podcast we have? No. Well, it first off started with my own fundamental education. I just flat out was lacking enough fundamental education to be able to speak in an articulate manner that would draw in investors to a deal. And just like most investors, I started out with my very close network, my friends, and that I knew that were interested in real estate, but they never had experience investing in real estate, and particularly in a syndication. And here it is I was trying to educate on the fly, and I was trying to present an opportunity to these potential investors that they had no idea what they were even looking at. And I couldn't articulate it because I didn't have the experience. I didn't have the knowledge. And so in hindsight, number one, it boiled down to a lack of education. And number two, it boiled down to a lack of experience, both on my end and the investors' end. Yeah. And so that really taught me the importance of education. Is what it is. Everybody knows you need to continue your education, but really taught me the importance of really getting more specific about and targeted and intentful about who your investor avatar is, and particularly those who are experienced in real estate or have a better knowledge of real estate investing, and particularly syndication. I know everybody says start with your friends and families, but man, that's the hardest group of people to raise money
because they
from.
know you.
They know you.
They remember you when you were 8 years old, and you like, you did that thing to the neighbor's flower garden, and you're gonna go buy an apartment complex. Come on.
You want how much money from me? And you were just drunk laying around the yard the other day. Yeah, no, it's
how many of those people have invested in deals since then?
None, because what happened is I made a pivot, right? And so I started getting, again, more intentful about networking with people that were actively involved in real estate, whether that be on the active side or passive side. And so not to say I ditched them, but I just made a pivot and started really building. Yeah. I started just growing my database of people already in the business. Now, I am still friends and close friends with a lot of those investors from that opportunity. And what's cool now is fast forward almost 3 years later, they see the growth, they see what we're doing, and now the interest is there. Right now,
that's what I was getting at, because I always tell folks, like, well, on your first one, if you're raising private money, never talk to on the first conversation like you don't need it. You don't have any deals. Usually the conversation goes, hey, this is what we do, blah blah blah. All of our deals are fully funded right now. I mean, when we get another opportunity, how would you like it if I shot it over to you and get your opinion? And then, so by doing that, because you're not desperate, but the moment they sense desperation or lack of confidence, which is probably related, it's done. It's done. But they will watch. They will all watch and see how you progress. And if you're sincere, like you've been, they'll come back. A lot of them.
You are 100% accurate, and this is where patience and discipline come into play. This is a long-term game. And when you're starting out, everybody's going to make mistakes. I mean, we still make mistakes today. We're not experts by any means, right? It's always a learning and growing process, but you have to be willing to make those mistakes and put yourself out there and get uncomfortable and be patient enough to let your business grow. And people will watch and observe, even people that are in the background. This is why it's so critical to keep people in your database and keep them engaged, even in a passive position, like sending a newsletter, because you may not hear from somebody for 6 months and all of a sudden they pop up and be like, man, I've been watching your stuff and you guys are doing a lot of great things. I want to talk more. And it's an evolution. So, patience is definitely key, and discipline for sure.
Love it. Ryan, what are your thoughts on your first deal?
Yeah, I don't have that same story that Cody has about a failed first attempt. But our first deal, what Cody was mentioned, that was successful, that was a part of all three of us over at Blue Oak Capital, and it was strictly relationship based. I always tell people, and we've all heard this because we're all in the same industry. It's who, it's not how. And every opportunity that we've been a part of since, even the deals, the deal we won on our own, has strictly been because we had a better relationship than the other person, right? So our first opportunity came early 2021. And it was strictly based off a relationship that I know Cody had started, I believe, before you even met me, with the lead sponsor, and just continuing to nurture that relationship. And that's the thing about this business when you're trying to add value to others. So many people say they want to partner with you. They say they want to add value to you, and then they disappear, right? A lot of people say they want to invest in real estate, and then they don't. They're there for 1 minute, and then they're not there anymore because they realize that it's really hard. It's especially, I think, the barrier to entry in commercial real estate.
They want the result. They don't want to do the work.
Correct. And I think the barriers right now, because the purchase prices are so high now, the debt, I mean, they're arguably still giving out free money, even though interest rates are taking a little bit. Money's still relatively easy to get right now, but the deals are hard to find. And people, they come, they start to hop on the train and they realize how hard it is. And they just go, oh, never mind. I'm going to go find the next shiny object, whatever that is. Right. But Cody had been building that relationship, and John with the lead sponsor. And we were fortunate enough to be able to prove ourselves. We kept showing up, kept meeting that person, kept going to lunch, going on property tours with them. And, eventually we're presented with the opportunity to partner with them because we had built that trust, build that rapport. And then it was really on us, where it was kind of a, Cody used the term like crap or get off the pot kind of moment, where you're being presented with the opportunity to be in your first deal. And it's a pretty big deal. It's 240 units. So to go from buying some single family houses, which is what we were doing prior, a year and a half before, to buying a 200 unit apartment complex, that's a pretty big swing.
Yeah.
But it was a relationship based thing. And then it was time to either take action or don't. So we had to decide as a team, like, look, this is the opportunity. And I'm so glad we did, because that's the one that sort of catapulted us to where we're at now. Not that we're rock stars or anything, but we're building momentum. The snowball is starting to grow. But you got to take a leap of faith, and you got to take action, and then you got to set up your foundation, and you got to trust in the process, because you've built something, you've built this machine, you've built this system, whether it's acquisitions or raising capital or both, or asset management. Now you got to go out there and let it do its job. And I'll say it worked pretty well.
Love it. Love it. Yeah. I think y'all's progression on that is very similar to mine. We're building relationships and watching, observing. Now I take action. So I'm not the one to go out there and observe and ask questions and disappear. But when it finally came after a few different opportunities, reviewing it, finding the right one, and then boom, this is ready. Let's go for it. And going from single family to a 384 unit in Florida was it was exciting, and we got some other exciting news on that one that I may get to share in coming weeks. What are your top KPIs when you're looking at an opportunity? Obviously, there's a lot of numbers that go into, and not just numbers, because there's management, there's location, there's all kinds of things. But what are some of the top KPIs that you look for to give you that quick understanding that, hey, this is a deal worth looking into more? Because a full underwriting of an apartment complex, which is a business, it takes some time. But before you start investing that time, what are some of the top things that you're looking at that, hey, I think this is worth looking into? Let's dive in deeper.
Cody, before you answer that, I was because you're the underwriter, Cody's our acquisitions guy, but I want to real quick just highlight before Cody gets into the details, because I know he will, is I think for investors, especially because I focus on investor relations and marketing and things of that nature. And I think, Cody, correct me if I'm wrong, we've gotten better about this, even just looking at, a deal hits your inbox. The story and the location is so important. Forget the dollars. It could be the best deal on paper, but if it's a D class asset in a D class neighborhood, it doesn't matter what type of returns it pushes out, right? The story is so important. The location is so important, because at the end of the day, we're raising capital and we're partnering with other investors who want the returns of, the capital returns and the equity appreciation, the tax benefits. Nobody wants to own this junk building in some town that they've never heard of. And then you got to think about your exit. Who's buying that, right? You might find this amazing deal 4 hours away from Houston in some town that nobody's ever heard of that's got 500 people.
You can't change that. But you
can
can't change the way the property looks and the way it's managed. But
exactly. So I think we've gotten better at, before we start looking at the details of KPIs and cap rates and all that stuff, it's like, okay, where's this at and what's the story? If it's good, if we like the location and we like the story of the property, we feel like this is something we can buy into ourselves and then therefore confidently pass that on to our investors when we're raising capital, then we proceed. I'll let Cody take it from here.
Yeah, no, that's a great intro to that conversation, Brian. I mean, you're exactly right. It comes down to location and story for sure. So first off, we look at the market. Is it a market that is our target market? Do we want to be invested in? And then we boil down to the micro market. Is this in a particular sub market within that general area that we want to be invested in? So, if we're looking at Houston, San Antonio, we have very defined micro markets that we particularly focus our interest in, and anything outside of that, it just goes immediately to the junk box. We don't even take a look at it, right? And then, like you said, we look at the deal. Does it fit our investing thesis? Right now, we're very, very much leaning towards the core plus assets right now. So anything that's a newer building, stabilized occupancy, we don't want the deep value add reposition type products right now, just because we feel like on a risk adjusted basis, it doesn't make most sense right now. So But then looking at the property level, then you got to look at, things like, hey, what's the in-place cash flow, net operating income? Can that support good debt? If I'm going to go buy a building on a 5-year hold, can I secure the debt that matches that 5-year business plan? So that's the first thing I look at is what's the in-place cash flow and net operating income, and can it support the new debt? The second thing is I look at what's the overall gross potential income, where it is now, and then what's the delta as far as the market comps. Can we increase that gross potential income through either a value add strategy or capturing other income like fees and whatever other items that may be missing? And then looking at the expenses, are there anything on the expense side that we can reduce or maybe cut that is running a little heavy, and just trying to get that story. So, and kind of keep this general without going in too much in the weeds here. But so looking at, again, gross potential income over the expenses, and then really where does that fit into where the market performance is right now? So, but really it just comes down, most importantly, is the in-place cash flow and the debt.
Mm-hmm. You touched on two terms that let's just highlight for those who don't know what they are. You said core and core plus. Just brief explanation on what those are.
Yeah. Sorry. So that's your A and B class product, right? So that's your buildings that are typically newer. Let's call it 1990s to present date building. They typically have better amenities, that are more modern amenities, modern finishes in and throughout the community that appeal to today's current standard of living, and typically are, better positioned most of the time in better ideal micro markets or locations within a certain sub market. So you're more of your value add or opportunistic deals are, again, those older buildings, let's call it 60s, 70s, 80s vintage, a lot of deferred maintenance, needs a lot of heavy lifting, so to speak, to really reposition it back up to market standards. So
yeah. I call those well located opportunistic deals. The huge value adds, but okay. So the Fed, they've come out where over the next 2 years we could be seeing 6 to 7 rate hikes. If that happens, that's one thing. I think the consensus is it will to some degree. And then how big those rate hikes are, we don't know. But how are you positioning? And either one of you pick this up. How are y'all navigating the underwriting process with that in mind? And maybe part of it, are you taking a little bit more cautious approach on bridge debt versus going in with agency straight up on the acquisition, or what are y'all doing on the acquisition side?
yeah, it's a great question. It's a great conversation too. It's very relevant. Obviously, I think it's on everybody's mind right now. And if you look at the transaction volume from last year, most of your acquisitional volume was done on floating rate bridge debt, and that's what our latest acquisition is. And so, going into a position like that where we are expecting rate increases over the next 12, 24 months, purchasing rate caps on your floating rate bridge is going to be critical. Your lenders are going to require it anyway, but just finding the right rate cap that's suited to your business needs. So, and what we do is, like, for example, we buy a 2-year rate cap at a 200 basis point spread, and then we model that in our underwriting to see if we hit that cap, can our pro forma projections cover that spread and cover that higher interest. And so if it can, and we feel comfortable with that, then we move forward. I think right now, right as we're going into this, rate hike environment, it's probably a very good time to start securing more long-term fixed rate debt. You could still lock in a very low attractive interest rate, and while rates do whatever they're going to do over the next 12 to 24 months, whatever volatility we see, I think now would be the best time to get into a fixed rate environment. So moving forward into this year, the assets that we're currently pursuing, that's going to be our strategy, is looking into lock in that low fixed rate debt. But here's what's interesting. I think the Fed is in a very, very difficult position right now, because if you ask my opinion, I think that the Fed moved from a very accommodative position on rates to a very hawkish position very quickly. And that's never really happened before. And I think that's probably because a lot of political influence, the Biden administration is getting a lot of heat for their, call it mishandling of inflation. And so I think there's a lot of political pressure that's now forcing the Fed's hand into act more aggressively. But the problem with this is it's on a very teetering slope where if they go too aggressive and they push too many hikes or hikes that are too aggressive, it could very rapidly put us right back into a recession type of environment. And we're starting this revolving cycle all over again where rates are going to drop and then quantitative easing gets coming back. And so I think to your point, it's going to be very interesting to see if we'll actually achieve 5-6 rate hikes over the next 12, 24 months. Nobody really knows. But I think the most important thing for anybody right now that's listening is keep a very open line of communication with your lenders. Keep having ongoing conversations, keep up to date on what the Fed is doing, where rates are falling, and have those conversations. I would even encourage probably on a weekly, biweekly basis with your lenders, just to make sure that you're keeping your finger on the pulse. So,
and highlighting what you said is capping the downside, which you were talking about, capping, you're capping the rate increase, your ceiling on that. That ultimately the biggest and best investors in the world, that's always their number one job. And if you go read like Ray Dalio stuff, you read Steve Schwartzman or Warren Buffett, it's always managing risk.
Yeah. And the other thing to that, Chris, too, is the other thing that we do, and this is every deal, whether it be fixed rate or bridge, is we also build in a lot of reserves for the what if. So we have working capital reserves, we have deferred maintenance reserves, we have other reserves that are set aside to kind of be well capitalized for that, just in case, right? You could try to what if your deal all day long, but the point is we do what we can with the lenders. We do what's required, but then we go above and beyond that and kind of really position ourselves as far as our capital stack to make sure that we have extra reserves for the what if. And I think that's just another layer of like you said, mitigating that downside. So,
So Brian, when talking with investors, so passive investors, folks that are going to be providing the equity for these deals, so you talk about how the story is important, the location is important, but what are some of the other key concerns, or maybe not even concerns, but just key pieces of information that and you're seeing that investors want in order to feel comfortable with further dialogue? And it may not mean that they actually commit to investing in that particular deal, but to entertain and go down that path of interest and hopefully investing.
Yeah, I think, it's important to go back to that conversation about your investor avatar because different investors ask very different questions. If you're talking to an investor who's very yield driven, they want that cash flow. They're very likely chasing those C class assets. So their questions might be revolved around the cash flow and how you guys are going to execute your value add plan in order to achieve those returns and different questions like that. We lean a little bit more on, like we've talked about, the core plus assets. You're going to have a little bit lesser yield. We're not going to have the same returns as a huge value add play, but it's also it's better because it's risk adjusted, right? So those investors, they're typically looking for more appreciation equity upside, and they're looking for tax benefits because they have jobs already or have other income streams through other investment vehicles where they're not living or looking for cash flow. Do they want cash flow? Yes, but it's not the primary driving factor behind their investment decision. So
they're looking for wealth preservation.
Wealth preservation, right. So somebody who's yield driven, they won't touch anything that's less than, say, 8%, just to use an example, versus, somebody who's looking for wealth preservation and you pitch them this awesome opportunity, a place for them to park their money that's more secure or more stabilized in their mind than a volatile stock market or cryptocurrencies. They might take a 5 or 6% cash on cash, but still have a 1.92x multiple on a 5 to 7 year hold, right? So I would say for us, some of the questions we get are definitely about people ask about the depreciation and tax benefits. They want to talk about cost segregation and how that can benefit them. I know on our deal we closed in December, that was a big conversation, the bonus depreciation, especially at the end of the year. A lot of people are looking for okay, it's that last quarter, I need to put some money to work to get those tax benefits. Especially, we talked about how somebody in the family is usually a realtor, right? So you have that real estate professional status, which can sort of blanket and benefit the whole family. Yeah. So that's a big conversation as well. And then really I would say, to kind of just keep it simple, they want to know, how are you going to protect their capital? what's the business plan? How are you going to put my money to work? And then what's sort of the worst case scenario, which goes back to, we were talking about sensitivity analysis. You guys have this floating rate debt or this fixed rate debt. What happens if this happens? And then what happens if that happens? And I think it goes back to Cody's point about when he was raising capital the first time, being able to confidently answer those questions. Nobody has a crystal ball, right? So we can say we have this, we have that, we have this abundance amount of reserves, and we have this rate cap in place, and we're planning on refinancing into fixed rate debt. You can say all the right things, but which is important because you want to have a response to everything, but we don't have a crystal ball. And all you can really do is let them know, like, look, we have different exit options and different strategies in place depending on what happens with the market. And I think that really gives investors confidence, because if you go to somebody and say, hey, this deal's amazing, but it's only amazing if this particular scenario plays out. Rates have to stay low, rents have to keep going up, Amazon has to build a new facility next door like they're talking about. If those are the only things that make it a good deal, that makes it a little risky for the investor and not as comfortable versus saying like, hey, here's our sensitivity analysis. Here's what happens if we don't hit our pro forma rents. Here's what happens if rates do go up and maybe we get closer to that rate cap. Here's what happened if we don't continue to see cap rate compression and cap rates actually go up a little bit. Here are the different scenarios based on that. And I think showing them that you've educated yourself and that you have those options available gives them confidence that you've done your homework, which is, that's really important to them, because people don't want to park their money with somebody who, like Cody was saying, you're not educated enough. So that's really important. So I would say those are the big things that we really get talking to this accredited investors that we really target as our investor avatar. Cody, anything you want to add to that?
Yeah, no, I think you hit the nail on the head. And I think it goes back to the importance of identifying what your thesis is and going to specifically be intentful about the type of investors that you're attracting that align with your thesis. And, to Brian's point, I mean, look, when it comes to the equity side, your cost of equity is ultimately what's going to allow you to be competitive when you talk about raising capital, right? And there is a significant difference overall versus the accredited and non-accredited investor. We're not going to go into detail about that, but you got to basically find the investors that fit your investing thesis and align with your strategy. And if you have a lower cost of equity, it can give you a lot better competitive advantage. So you just got to figure out what that means to you and what your strategy is. But I think, Brian, you did a good job there.
Yeah. And I talk with a lot of even high income earners, and they're like, I was talking with one yesterday, and we were at my son's basketball game, and he was just like thinking about buying foreclosures for rental properties, just paying cash. And but a lot of them, they don't quite understand, because it's difficult having a full-time job, even you're making a lot of money, and then having to go out there and compete in a low inventory market for single family. And then you want to take foreclosures, which is even tighter of an inventory standpoint. And then you got to know the mechanics of going through the whole process. A lot of those folks, my advice is like, you can do that. Like, there's nothing wrong with it, and there's a lot of benefits to it. Have you considered just being a passive investor? Because all of those headaches that come across, like most of that stuff can be diverted to a high quality, trusting, experienced operator. And then you can come in and provide the liquidity, and you're passive. Like you sit back and enjoy all the nice benefits of investing, and not the headaches of, we had a fire, or one of the units flooded, or man, the police came by yesterday because someone had loud music, and like, you don't have to deal with any of that stuff. Or with the single family, hey, it's Friday at 6:00 on July 3rd, and my AC unit went out. I need you to fix it now.
Like, from experience, Chris.
No, that happened last year, and I very politely told him, like, we'll get it taken care of. It will be Monday. And he was a rake. And I was telling him, like, look, it's a friggin' holiday weekend. It'll be Monday. And he fought, and he got it fixed on Monday. But man, I'm willing to take Chris.
That. No, I agree with your point. And Cody and I talk about this quite often, that a lot of people want the benefits of real estate, but they can't necessarily do the work, especially if you're a high income earner, and that's the beauty of what we're doing, especially with commercial real estate. Not that you can't be a hard money lender or private equity investor for single family. Those are great avenues too, if you're looking for more short-term type transactions. But, and what we're doing is we're partnering with those people that want the benefits of real estate. They want the cash flow. They want the equity. They want the appreciation. They want the tax benefits, and then they want that hedge against inflation, which is a whole nother topic we haven't, touched yet. But and they get to enjoy all those benefits, but they don't get to have to deal with all the stuff that Cody and I, hit our head on the wall for sometimes, negotiating with sellers, dealing with brokers, insurance, property managers. Not that those are bad experiences, but they're a lot of work, right? And that's why commercial real estate or real estate is so beautiful, is because you can figure out where the shoe best fits, right? If you have a great job and you want to diversify, you're making money in stocks, you're making money in crypto, your 401k is going well, you got an IRA, awesome, keep doing that stuff. We're not telling you to stop and move everything over to real estate. You can if you want to, but you don't have to. And real estate can be a great diversification vehicle where you can take some of that wealth you've created and help protect it against something that's better risk adjusted, that has not as volatile, right? Which is both good and bad because it's not as liquid. You can't just pull your money out if things aren't going very well. And you can put a little bit of it in real estate and enjoy the benefits, form a great relationship with a great operator, and enjoy all the benefits of real estate, but without having to do all of the work. So that's one of the big reasons we like real estate. And just to hit that point, a lot of people who say they want to invest in real estate that have a high net worth of liquidity, they just don't have the time, because it is a tremendous amount of time. I know, Cody, I don't know how many hours a week we do this, but we're very thankful we have nice wives. I'll just put that out there.
Yeah. There's definitely nothing passive about being a real estate investor, unless you truly are taking a passive position in a thing
Operator,
like a syndication.
being an operator.
Right. And that's the difference, right? And I think when you're dealing with, high income earners, they're typically used to being the more intelligent person in the room, right? There's doctors, lawyers, engineers, whatever the case may be. They're usually the smartest person around, and they typically are accustomed to that. And so, but what they don't realize is when you go buy that single family home or that property, you're active. You're not passive by any means, unless you're just going to be a complete slumlord, which I would argue most people don't want to be. So that's the benefit of having a podcast medium or thought leadership medium like we have now, is to be able to share this knowledge and experience and open people's worlds to this idea of syndication, which will truly fit their lifestyle and their investing thesis. So keep sharing the message.
All right, wrapping up. Ask same questions for everyone. So we'll kind of let y'all tally each of these questions individually. If you could give advice to your 20-year-old self, and I know we're all very young in this room, but your younger self, if you can give advice, what would it be?
Don't go chasing shiny objects. Take it from me, I learned a very extensive, expensive lessons along the way in chasing shiny objects. Be disciplined, laser focused, be patient. That would be my message.
Love it.
Yeah, for me, it would be something you've probably heard before, but it would just be buy more real estate sooner. Over the course of time, real estate always goes up in value. It's all about time, right? So if I had started doing what I was doing now when I was 20, who knows what would be happening now? That would I guess 2010. I'm 32, so it was a great time to start buying real estate right after the Great Recession. Multifamily was about to catch fire. It still is fire, but it was really at the tail beginning of that. So for me, it would be just get started. I would say the best time to buy real estate was yesterday. We've all heard that saying before. So there is no bad time to buy real estate. A lot of people like to wait for crashes, or they're scared to buy because of interest rates. There's always a good time to buy real estate as long as you have a long enough time horizon and you're responsible, right? You buy good assets in good neighborhoods that people want to live in. You provide value to them, and you put good debt on it, and you have good partners. There's no that works in any market cycle. So go out there and buy some real estate.
Yeah, people always need a place to live.
Right.
What book or books have greatly influenced your life?
Yeah, we were just talking about this on another recording earlier today, and I'm going to kind of reciprocate this again. Think and Grow Rich is a book that I read, several years back, and it's something that just coincidentally just recirculated on my desk and got to thinking about it. And as I mentioned in my past with other people, is listen, financial independence is a mindset. Generational wealth is a mindset, and success is a mindset. And so I think a book like Think and Grow Rich is a perfect articulation of that where, it's all about the mindset. So that's a book that I think is very relevant, even though it was written, God, however many decades ago. It's still very much applicable to entrepreneurs today. So I really like that one.
Yeah, that's a great one, Cody. I really like The 7 Habits of Highly Effective People by Stephen Covey. It's not a real estate book per se, but Cody used the word mindset. And that's really what that book tries to do, is tries to lay a foundation of good habits that you need to have to be a great dad, to be a great, mom, to be a great entrepreneur, or to be a great employee, if that's the route you choose to be. So I think having those habits in your life and just kind of recycling them and refreshing them on an annual basis, that's something I try to do. And that was a book that I think I read right out of college and sort of just changed my paradigm tremendously in a positive way.
Mhm. What, or in the last 5 years, what new belief, behavior, or habit has most improved your life?
Never being afraid to fail, getting comfortable with being uncomfortable. And I think accepting that and just really putting yourself out there and, like I said, just going for it. Who cares what happens? Just go for it and take chances. I think has been just an absolute game changer for me personally, professionally, and I think it's paying off dividends because we all take that same approach at Blue Oak Capital. So I would definitely say, yeah, never be afraid to fail.
What just when you said that, what popped in my head was David Goggins. He's like been floating through my TikTok and little sound bits, and I can hear him in my head and just saying like, uh, are you afraid to go and run because it's cold? That means you need to get out there and run when it's cold. Are you afraid to go too afraid to go and run when it's hot? That means you need to get out there and pray. Are you too afraid to make that offer? That means you need to be making 5 offers. Just do it. How about you,
Yeah,
Brian?
mine's was similar. I just gonna say think big. We all limit ourselves. We have a lot of limiting self beliefs. Again, it's another cheesy sort of mindset thing, but the sky is the limit, right? You're only gonna buy what you think you can buy. You're only gonna raise capital on how much you think you can raise. You're only gonna do what you set your mind to. So I would say go out there, think big, be afraid to fail, like Cody says, be afraid to take some risks and get uncomfortable as well, because success is on the other side of comfort. If you're not uncomfortable, you're not growing.
Yeah, one trick, I'm sure y'all have experienced this. One thing that I've known or I've experienced when I'm thinking too small is when you sit in the room with great people, like doing things, and you realize, like, holy cow, like
Yep.
maybe I'm playing it easy. um, how can people reach out to you?
Oh, that's an easy one. We're pretty present on social media, I like to say. So they can find us on Facebook or on LinkedIn or on Instagram. You can connect with Cody and I there. You can also reach us by email, Brian at blueoakinvest with an S at the end.com or Cody at blueoakinvest.com. Feel free to send us an email or shoot us a message. You can also visit our website. If you'd like to learn more about what we're doing, I'll do a shameless plug and say we have a great podcast as well. We have a virtual meetup and in-person meetup here in Houston. We also offer lots of educational content on a weekly basis as well. So if you're interested more in learning how to be an active or passive investor in particular, just go to our website, drop your email in, sign up for our newsletter, get into our network, and we'd love to connect with you there.
Love it, love it.
And our website is blueoakinvest.com. Not forget that.
All right, thank you so much. It's been a real pleasure. Look forward to hanging out with y'all again soon. Or I
Thanks.
guess I'll be seeing y'all Saturday.
Yep.
Yeah.
Thanks for having us, Chris.
Absolutely, take care.